Hello, I'm Gavin McGuire, Special Situations Analyst for Briefing.com. Today is Thursday, January 14th. JPMorgan will be the first major banking giant to report earnings this season when it reports Q4 results tomorrow before the market opens. A conference call will follow at 9 a.m. Eastern Time. Analysts are expecting EPS to come in at 60 cents on revenues of $27 billion. JPMorgan is going up against easy year-over-year expectations, so the market will judge results against Q3. An inline scenario would represent a modest quarter-over-quarter rise in revenue, but approximately a 20% drop in earnings. The bank has blown away the bottom line by an average of 27 cents the past 2 quarters, and will likely need another similar performance, as shares have had a difficult time pushing above 47. The overhang of the proposed White House taxation only amplifies this report. Taking a look at the full body of work, the revenue figure, if in line, and there really is no reason to believe it will not be, would present a 50% year-over-year increase, which would certainly look good on paper and headlines, but the slight uptick from Q3 will be the bigger story. Q3 net income was $3.6 billion, and right now it looks like JPMorgan could report a lower figure, so we would watch that closely. In Q3, the bank put away $2 billion into its consumer credit reserves, building its coffers to $31.5 billion. The $31.5 billion is a healthy amount, but look for it to put away some more, albeit at a lower rate. The firm-wide loss to loan rate stood at 5.3% in Q3, while the Tier 1 capital ratio was at 10.2% and common ratio was at 8.2% as of September 30th. Another very important item to watch will be the dividend, which stands at 80 cents per year right now. CEO Jamie Dimon has said it would like to boost this to $1, but only after clear signs the economy has improved. We think it is too early for them to make this call, especially with the tax issues looming, and would be surprised to see them make such a move. Building on that, we would watch for the announcement of bonuses, which will grab plenty of headlines given the current environment. Finally, from an economic standpoint, watch for the lending, which was at $46 billion in Q3, down 3% sequentially. Investment banking has been the driving force behind the 2 big beats. There's little expectation the bank can build on the $7.5 billion in revenues from Q3, so this bears watching. Profits have also been strong thanks in part to lower credit costs, so we would continue watching for increases here. Retail financial revenues were strong in Q3 at $8.2 billion, but provisions remained high at $3.9 billion compared to $3.8 billion in Q2, reflecting continuing weakness in the home equity and mortgage loan portfolios, particularly from WAMU. Q3 home equity net charge-offs were $1.1 billion, which represented 4.25% of loans, compared to 4.62% in Q2. JPMorgan has stated that losses in home lending will run about $1.4 billion a quarter, so keep this figure in mind as it tends to scare people, even though it has been known for some time. Card services remain a key area for the bank as it battles high unemployment rates and a heavily indebted society. In Q3, JPMorgan reported a loss of $700 million, driven by the higher provision costs. Managed net charge-offs were 10.3% in Q3, up from 10.03% in Q2. The results decelerated on a quarter-over-quarter basis, but at very high levels, so hardly a positive. JPMorgan issued a payment holiday, which is expected to lower NCOs by about 60 basis points for Chase cards, but the number is expected to jump back to 11% in Q1, also due to the payment holiday. A better-than-expected number here may jump shares, but we would expect the boost to be short-lived as issues continue to be ironed out. We hope that helps you prepare for the report for tomorrow. Good luck and happy trading.